Please go ahead.
Thanks, David, and hello, everyone. Thanks for joining us today. As you know, if you've attended these, we strive to answer the questions during these calls that we're hearing most often from our clients. Frequently, these questions have to do with the economy or the markets or planning topics. But sometimes they're also more logistical in nature, more administrative. And we know that if some clients are asking these questions, there's probably more of you who are thinking them or wondering them. So I want to take a minute and just talk about some of these. So one of the questions we hear often from clients is, who do I call for what at Albion? As you know, or hopefully you know, we take a team approach here in working with our clients. We want more than one person to know you and to be available when you reach out and you need something. But that can also cause clients to wonder, leave clients wondering, who do I call for different services? Now, the short answer to that question is you can call any of us anytime for anything. And if you call me and I'm not the right person to answer your question, I'm certainly going to find the right person to talk to you. But we've heard from clients a desire for a little bit more clarity there. And so I am going to attempt to provide that. So your senior wealth advisor, think of them as your Albion quarterback. They are the ones who are coordinating all the efforts, all aspects of your relationship with Albion. And just a good general rule of thumb is if you're looking for advice, call your senior wealth advisor. This could be advice about anything pertaining to your relationship with Albion or as us in the advisor seat. No, it could be not pertaining to your relationship with Albion. But if you're looking for your advice, your senior wealth advisor is a great place to start. All of our senior wealth advising teams also have an associate wealth advisor on their team. Now, our associate wealth advisors, they are the team members who are most often coordinating with our custodians, so Schwab or Fidelity, and reaching out to them if there's things that you need that might involve paperwork or forms, any kind of account updates. So if we're updating an address, if we're updating, external account information for a linked bank account, checking account, maybe it's even updating a beneficiary designation form if you know that that's required. Starting or reaching out with your associate wealth advisor first is what I would recommend. So the short answer is you can call any of us, but to the extent having that sort of delineation of when to call your senior wealth advisor versus your associate wealth advisor, hopefully that's helpful for you. Another question that we've been hearing quite a bit is questions around quarterly reports and also the Albion client portal. So you can opt to receive your Albion quarterly reports two ways. You can get paper reports that come to you in the mail, or you can choose to receive your reports electronically, which means that we're uploading them to your secure Albion client portal. And when we do so, we're sending you an email notifying you, hey, there's a new report uploaded for you to review, and then you can log in and view them. If you have any questions about your quarterly report, whether it's a question about something you see on your report, maybe it's a question of just understanding the information that we're providing in that report or how we're providing it, or maybe it's about accessing your report through the client portal, either trouble logging on or trouble navigating the portal, please reach out to us. We want to make sure that you are accessing and understanding the information that we're providing to you about your accounts and your relationship with us. If you have questions about the content of your reports or would like to walk through your reports, your advisor is a great person to contact, your senior wealth advisor. If you have questions about navigating the client portal or logging into the client portal, I would encourage you to first start with your associate wealth advisor on your team for those questions. And then lastly, we just got through tax season, and a lot of questions came up this year about how to pay your taxes. And so I want to talk about that for a second. The U.S. Treasury with the IRS is transitioning federal payments both to and from the government to electronic methods. And this is pursuant to an executive order that came out in March of last year. And then in addition to these efforts or this encouragement to pay your taxes electronically, the U.S. Postal Service, the USPS, has new rules around postmarks. And so new in 2026, if you are mailing something, if you're dropping it in the mailbox by your house or even at the post office or giving it to your carrier, there's no guarantee that you're going to get a postmark the day that you dropped it off or the day that you stuck it in the mailbox. It could be 1 to 3 days later that that piece of mail gets postmarked at a distribution center. And why this is relevant to taxes is if you're somebody who typically historically has paid your taxes via sending a check-in, and maybe you do so pretty close to the due date, relying on the fact that as long as it's postmarked by the 15th or whatever the due date is that year, it won't be considered late. A late payment by the IRS, well, that may no longer work for you. So what do? You can make your payments electronically. There's a website, the IRS Direct Pay website for individual taxpayers or tax filers. This is a pretty easy to use website. I've had clients who used it this year who said it was easier than they had anticipated. So that's one option. If you have to make a tax payment for an irrevocable trust or some sort of entity that isn't you as a person, unfortunately, you can't use that direct pay website. I wish you could, but you can't. So you have to use this EFTPS. It's another payment website through the government to make those tax payments. Unfortunately, it's a little bit clunkier and it does require you to get, multiple different login informations to verify your identity. But once you jump through those hoops and you've created an account, actually logging in and paying your taxes for those other entities is relatively straightforward. Our team here has spent quite a bit of time becoming versed in both sites, both payment options, electronic payment options, so that we could be resources to our clients on this. As we're hearing more CPAs, encouraging clients to pay their taxes electronically when possible. So if you want to explore the electronic payment options, but you need some help navigating the different sites, reach out to us, either your associate wealth advisor or your senior wealth advisor. You can still make payments via check, that they are still being accepted. I would just encourage you to give yourself a little bit more time before the due date to navigate that possible delayed postmark situation from the post office. You can actually go into the post office and request a manual postmark if you want to ensure it gets postmarked by a certain day, but you have to physically go into the post office and wait in line and have them do that. But there's no fee if that's your desire. So I'm thinking that this will become more of a topic in 2026, but just wanted to put it out there. And as always, call us if you have questions. And while I have the mic and we're talking about taxes, I'm going to keep going for a minute. Sorry, guys, my fellow panelists. And I just want to highlight some of the tax planning work that we've been doing for clients. I'm not sure if everybody's aware of the detailed tax planning work that we can do on your behalf. Of course, we're not CPAs, we don't file returns, but we are planners. And, we're able to help our clients both realize opportunities and avoid tax pitfalls. So the first thing we do, which clients can find very helpful, is just walk clients through their tax returns. Now, some of you might be very versed and understand your tax return completely. Others might not. And we found that just helping clients understand what's the drivers of the tax they owe can be helpful in and of itself. Not all income is taxed the same. But beyond that, helping clients in different planning scenarios. For example, we have a client right now who's doing a remodel, a home remodel, and she's contemplating, do I take more cash out of my account to pay cash for the remodel, or should I look at, a HELOC or a second mortgage, and potentially that additional interest deduction on my taxes will offset the interest that I'm paying. The money I might save on my top taxes could offset the extra expense of borrowing the money. And then also looking at the realized capital gains potential impacts on taxes if she takes the money from her portfolio. So those are the types of scenarios we can walk through and help clients with. Another is we have a client retiring soon, and he's not yet going to take Social Security, and he's not subject to required minimum distributions from retirements at this point, or retirement accounts at this point. So he's got a couple of years of low income. And so we're looking at how do we take advantage of that? What are the opportunities there to almost accelerate income into these low tax years or these low income years, if that makes sense? So that could be a Roth conversion. Does that fit for his particular situation? Or maybe it's just simply taking money out of his IRA now, even though he doesn't have to, even though he's not subject to required minimum distributions, but we can get dollars out of that IRA account at lower tax rates. So that is a common thing we're talking to clients about. And then I have another client who's looking at selling a rental property. And it's a property they've owned for a long time, so their cost basis is pretty low, and they're wondering if they should do a 1031 exchange. So essentially that's delaying the tax that they'd have to pay, kicking that proverbial tax can down the road, or if they can just sort of bite the bullet and sell the property, realize the gains, pay the tax, but then be done at this point in their life with owning rental properties and having that additional responsibility. So we can take a look at that for them in the context of their overall tax picture and help them understand the trade-offs of those decisions. And whether it's one-off events like those that I just described, or it's just yearly income planning to manage withdrawal strategies, sort of right-size charitable contributions, and then hopefully help you avoid it hitting maybe additional tax, such as the higher realized capital gains rate on long-term capital gains, or the net investment income additional tax. Not always possible, but if we're planning and looking at the overall income picture, we can take those into consideration. So we do work with CPAs as well. I just want to point that out. So if you have a CPA, it's not that we're doing this work in a vacuum. We're collaborating with your CPA. We're sharing this planning work that we're doing with them so that collectively we can add even more value for you on the tax planning side of things. So with that, I will turn the mic back over to David.
Thank you, Liz. Thanks for going through all of the tax planning work that we do. It's good to know. It's good to share that news with all of our clients here on the call. We're going to go from there into a conversation about that addresses some of the questions that have been addressed to us. So we'll cover a variety of subjects, but we'll begin with a question that a lot of people are wondering about, and I'll go ahead and ask: Are we heading toward a recession, or is the economy still on solid footing?
It's a good question. I'll jump on that one, David. We don't think recession is likely anytime soon. U.S. real GDP growth in 2025 was about 2.1%. Forecast for this year put it running at about the same pace, and we're talking about the U.S. economy. We actually think it could be a touch higher than that as we look at kind of the puts and takes, maybe closer to 2.5%. Bigger picture, global growth is running about a point above that, so call it low threes for this year around the world in terms of GDP growth. Supporting this growth is a steady consumer underpinned by mostly full employment with wages that are still growing faster than inflation, higher asset prices, which make, consumer and household balance sheets flush and folks more willing to spend money. For instance, I'd call out that payments giant Visa reported quarterly earnings results last night. And in that report, they showed strong spending and impressive consumer resilience. Transactions and payment volumes in the report were up 9% year over year. The big banks all said the same thing 2 weeks ago when they reported earnings. When we zoom out a bit, the macro statistics like retail sales and personal consumption expenditures, which is the broadest measure there is in terms of consumption in the US economy, those are also showing record levels of consumer activity. Another tailwind that is certainly helping the economy is we have a massive AI CapEx cycle that's adding to growth. The four big spenders in tech, Amazon, Microsoft, Alphabet, Google, and Meta, all of which, by the way, also report earnings later today. They're set to invest as much as $700 billion this year alone on data centers and AI infrastructure. To give you some context, last year that was $415 billion, and in 2024 it was $240 billion. So that's a lot of spending, and with it, there's a multiplier effect across tech and other sectors that really boosts economic growth. The final thing that I would call out is there's a pro-growth fiscal tailwind this year from the federal government that didn't exist last year in 2025. We have tax cuts, we have higher defense spending, we have deregulation, and other areas that are kind of pushing growth incrementally higher. So if we set the politics aside from those things, they're core planks that are adding to growth this year that we didn't have last year. And so when we add those things up, consumer spending, business fixed investment, government outlays, they combine for well over 90% of total GDP, and all of them seem to be directionally moving in a positive way. And so our takeaway is that the economy is doing fine and that we'll likely see a decent growth year for the US economy.
All right, Jason, thank you for that answer. That sounds like good news. Then I guess I wonder, what is the Federal Reserve doing right now, and when might they cut rates again, or might they even raise rates?
Yeah. So I'll jump in again. So the Fed is doing a couple of things right now. For starters, they just concluded Jerome Powell's final meeting as chairman after 8 years in the role. As expected, and this literally happened 20 minutes ago, as expected, they announced no changes to interest rates today. Kevin Warsh will soon replace Powell as the head of the central bank. And so that's one thing the Fed is focused on right now is transition. The second piece, of course, is setting monetary policy, which is their core job. And after driving the Fed funds rate up to 5.5% in 2023 to fight high inflation, the Fed began cutting interest rates in late 2024 back down to a level consistent with a more balanced economy. They cut 3 times again last fall. And so together, there have been 6 cuts off of that 5.5% high water mark that have reduced rates by almost 2%. It's 1.75% since they've been reducing rates. They've since paused in 2026 as the Fed feels rates are now closer to where they should be given economic conditions. We can talk a little bit more about that. And B, that's essentially what the Fed calls neutral, by the way. If you hear that term in the paper or on TV, Fed's trying to get to neutral. That's essentially where they think rates are in a position where it helps the economy stay in balance. It's neither stimulative or restrictive. And then B, inflation. Importantly, inflation has remained stubbornly above their 2% goal. Plus, we now have a war in the Middle East driving up oil and gas prices, jet fuel, fertilizer costs, et cetera. And at the same time, the jobs market is doing okay. So the Fed, at least for now, seems inclined to hold in place to see where things go from here.
David, an observation I'd like to make. First, Liz, thank you for your tax thoughts. Those are super helpful. And Jason, I always enjoy your commentary. We're working on a couple of questions here. Are we heading toward a recession? Is the economy on solid footing? What's the Fed going to do? I'd like to step back a little bit. The market and us prognosticators, that's a big word, multisyllable, prognosticators have forecast 11 of the last 3 recessions, meaning there is always the perspective that we're looking for the hole to fall into. Investors who react to that end up missing out on a whole lot of positive market activity. So while I think it's very important to have these opinions and have some sense of what we want to do with them, the question that it begs is, okay, well, what do you do with the information? And we will get to that later in this conversation, but just to be clear, we work hard to have a forecast and have some sense of what's happening, in the market, and more importantly, what's happening in the individual companies that we own. But that's only the start. The next section is, okay, you have that information and perspective. What do you do with it? More often than not, continuing to own good companies is the best path. A lot of people have missed out on a lot of gains by forecasting recessions, stepping aside, and waiting till the markets feel safer. They actually never feel safe, especially when there's opportunity at hand.
No, and I just will say, John, what I hear so often to that point about the markets never feel safe is, when the markets are up and hitting all-time highs, clients are worried about when it's going to go down. And when markets are down, they're worried about when they're going to go lower. So there's always that sense of worry, even, regardless of what the markets are doing.
That's the price of being human.
Okay, well, thanks for painting a picture of the landscape that we're dealing with now as investors. I get let's step out from that discussion into a general question about well, a more specific question, I suppose. What's going on with oil prices and the general situation in the Middle East? Does it matter for the economy and the markets that you're just discussing?
It's a great question. It's a timely question, of course. The short answer is things are messy. We're now nearly 9 weeks into this conflict. There's been tens of billions spent fighting it, many multiples higher in true costs, thousands killed, millions displaced. That's the accounting cost so far, and that's the human cost, and it's terrible. It's just awful, and none of us like to see this going on. The headlines are certainly volatile, and we're waiting to see how this thing fleshes out. But when assessing the situation through the lens of the economy and financial markets, we're much more sanguine. Despite crude oil prices higher by 60% since the war began, we haven't really seen a negative impact on the US economy. Those drivers I spoke of before, the consumer, AI investment, fiscal stimulus, they're all working to, so far, fully offset the slowing effect from higher commodity prices. And we expect this is probably going to continue. We can unpack that a little bit more. And I recognize that sort of sounds implausible, right? This idea of like oil prices are up so much and I'm feeling it at the pump. And so how can that not impact the economy in a negative way? So I'll give you just a quick numerical example. While analyses vary on this front, depending on like what oil price one assumes in their model, the consensus seems to be that higher gas prices for the balance of this year, so just kind of looking at the forward oil curve and implying what gas prices will be, that in total, that'll hit household budgets by about $100 billion. While the boost from higher tax refunds, so we talked about that fiscal stimulus, amounts to north of 150 billion. And so there's an offset happening on the fiscal side, mainly through higher tax refunds to households that is fully offsetting what's happening at the pump. Now, there are other areas where higher energy prices show up that's not in that analysis, higher electricity bills, higher heating costs, packaging costs, transportation costs. So that $100 billion figure, assuming this conflict continues for the next several months, is probably going to be a bit higher. But the point is the same. Bigger tax refunds alone, and that's not even talking about the AI tailwind and all these other things, are an offset that should largely leave undeterred the central drivers of the economy. And so definitely a situation we're watching closely. Very unfortunate what's happening, but so far it hasn't impacted the economy, hasn't really impacted the markets outside of a bout of volatility for a couple of weeks before a quick snapback. And so those are the puts and takes as we see it.
Well, this question isn't written down, Jason, but you talk about feeling it at the pump and but electricity costs are going up. But are people who drive EVs dodging the extra price of gas by driving EVs?
Yeah, it's a great follow on, and I would just say short answer yes. But even those who are still driving, regular gas cars. When you look at the overall spend, and again, this is as an economist, obviously households vary, but when you look at overall spend, the percentage of dollars in the budget that go toward filling up the gas tank is somewhere between 2 and 5% of total household budgets. Now, again, you can go down the income spectrum, and I think at the highest level, it's 15 to 20% when, the lower down the income spectrum you go. But in general, it's low single digits. And so, yes, EV folks, and I count myself as someone who drives an EV, we get to dodge the price at the pump. But those who are driving gas cars are paying less as a percentage of their overall budget today than they were a decade ago, 30 years ago, and certainly in the 1970s.
Okay. Thank you. So, depending on who you listen to, AI is either really positive or potentially really negative. From your perch, how is AI, artificial intelligence, actually impacting the economy and corporate profits and the markets?
I'll jump in. No surprise,
Thought you
right?
might.
Thank you.
Look, AI is real. It's transformational. It's already showing up in corporate spending and productivity, as we mentioned. Massive amounts of AI capex that's happening. 700 billion this year, probably going to 800 billion next year. And as mentioned, because of that fact, companies are heavily investing in infrastructure and software and automation. That's one, supporting GDP. And two, more importantly, it's supporting earnings growth. And we're seeing that show up in the data pretty clearly. The key point here, of course, is at least in terms of stocks and how it impacts the financial markets, is that corporate profits are still growing, in part because of what's happening in AI, both at the spending level, the big mega cap tech companies that are spending massive amounts of money to build out the critical infrastructure to run AI, but also at this stage, and this is kind of layer two, we're seeing more companies implementing AI in their businesses to increase productivity. And as many of you have listened to me opine about the economy and markets before, productivity is sort of like the magic elixir of economic growth. And so to the extent that AI is a net tailwind in terms of GDP, a tailwind in terms of corporate profits, and indeed a tailwind in terms of productivity, then that kind of tells us this isn't just hype, it's translating into real impact. And so that's like the 60-second overview of AI. And of course, like there's two different camps. There's like the through line, which is where we are. We think it's going to be a net positive over time. And then there's the camp that's really optimistic and says like, no one's ever going to have to work again. And we're going to have like, this utopia of total abundance. And then there's the other camp that says that, we're going to end up in a Terminator movie. Our belief is that the truth is in the middle, and that like every technology in the past, it will be incrementally positive in the years and decades ahead.
In my history with Albion, which is several decades now, we have watched various technologies come through industries and impact productivity. It's happened here at Albion, clearly over time, over the decades. Each time there's a concern that, my gosh, how are we going to replace those jobs? What will people do? And each time the economy solved it. People often moved to higher order tasks, things that were actually more rewarding as these tools took over those roles. Clearly, AI, we're concerned about inaccurate data. Certainly, it aims to please, so we certainly wouldn't use it for investment advice, but it's really good at some things. For example, feedback we've gotten from clients is, could you create a written summary, a short summary of these conference calls? Because I want to know what you said, but I don't have time. So we're actually recording the call, and we will have AI take the first pass at summarizing what we're talking about. And then, of course, we edit it, but it's a great productivity enhancer for us. So these tools are there. They're part of the ecosystem. They are going to increase productivity. And yes, we need to worry about the camp that has some valid points about AI causing a whole lot of problems.
Okay, thank you. What thoughts do you have on what's happening in private credit?
You want to go first, Jason, or you want me to take a stab?
I'll let you go first, and then I'll build on what you've got.
Private credit, for those who aren't clear, it's a way to borrow money when you really can't get the bank loans you want from the significant financial centers. There are big pools of capital, similar to private equity, that lend money to companies. The challenge is, what are the lending standards? They tend to be less rigorous than if you go to a major bank. So you end up with higher risk credits. The perspective, what we're seeing is private credit is definitely making headlines for some defaults that are occurring. My sense is the problem is not nearly as deep and broad as the headlines would have you believe. So, and we also have to look at private credit in terms of what percent of the total lending economy do they represent? It's a pretty small percentage. Jason probably knows that number, being who he is. So it's good headline. It's certainly something to watch out for. If you have significant investments through private credit pools, odds are there'll be some defaults in those portfolios, but it's not a watershed event that is going to bring the economy down.
Yeah, I would expand on that. I would agree. Private credit is healthy and a necessary part of today's capital market structure. It's certainly grown a lot over the last 15 years. The primary engine of that growth was because after the financial crisis in 2008, banks stopped lending, in part because of the crisis, but also in part because regulations went up in terms of making sure the banks were structurally sound. And so private credit went from a couple hundred billion in terms of total asset size to close to 2 trillion today. So we've had this really like hockey stick trajectory of assets in private credit. But to John's point, if you look at it, A versus the overall size of the economy, which is 31 trillion, and B versus like the size of financial markets, which is even bigger than that, it's a fairly small piece of the overall pie. And look, I think it's important to know like it's going to go through cycles. We haven't seen a cycle in private credit because it's somewhat newer. But like all areas of financial markets, it's going to go through cycles. We're starting to see some small stresses emerge right now, particularly in some of the weaker credits. And I think particularly, and this is a really important piece to remember when you see these headlines, there was a fair amount of retail participation in private credit, especially over the last 5, 10 years. These aren't institutional investors like the big banks or hedge funds or insurance companies, but rather these are mom and pop investors, for lack of a better phrase, that heard about private credit and maybe invested in private credit, but didn't fully understand what they own and how it works. And so, because we're starting to see some challenges there, we're seeing some of those folks who didn't quite understand what they owned and how it works, trying to redeem their capital back. But there are natural gates that are put in these private credit funds because they have to match liabilities and assets. There are some withdrawal limits, usually 5%, that these funds install. And so we've had a bit of an uptick from retail saying, hey, I want my money out, I'm scared. And that's creating the volatility more so than the value and the quality of the underlying assets. So structurally, like big picture, we think that private credit is far less likely to be a source of a financial crisis like big banks were and insurance companies 17 years ago. It's not like what we saw in 2023 with Silicon Valley Bank. Leverage in the private credit space is so much lower. The banking system today is so much healthier. And these losses in private credit, should they occur, I think they're best thought of as hits to investment returns among like a big pool of investments as opposed to systemic loan issues. And so pockets of risk, yes, but limited in scope.
And I'd also
Okay, thank you.
just jump in here and add, when we're talking about any kind of private investment, private credit, private equity, when we're working with our clients or we're helping our clients address questions around this or interest in investing, we're also looking at the right size of an investment in context of their overall net worth and keeping in mind the overall asset allocation, right? So thinking about if this is an area of investment that is appropriate for you, given your situation, what is the right size of that investment so that it maintains like a very healthy place on your balance sheet, and healthy in this sense, not meaning large, but means appropriate for the risk that you want to take.
Yeah, it's a really good point.
Okay, thank you. I'm going to move into a set of questions around investor behavior in the markets, and we've touched on some of this. So, but this is a new question here. So, with markets at or near all-time highs, should I wait for things to calm down or dollar cost average in gradually, given all the volatility? And maybe someone could describe to the uneducated what dollar cost averaging is.
I'm happy to jump in here. And even the very educated might not know what dollar cost averaging is, because it's a bit of a financial jargon term. But essentially, dollar cost averaging is when you have a sum of money that you're going to invest in the market, and you take that and you invest a little bit over a period of time. So you're putting some money to work, at different increments. You're dollar cost averaging into the market, meaning you're buying in, and we're generally talking about the equity markets, but not exclusively. You're buying in over, at different prices over a period of time. And a really good sort of analogy or example of this is, think of investing through a 401k, like your employer 401k. When you are contributing to a 401k plan, every pay period, some portion of your paycheck is being directed to invest into your 401k, and then it's being invested, in the market per your investment policy. So that's a natural or a default, example of dollar cost averaging. And this is a question, really the question is, do I want to take that lump sum of money that I may be looking at investing, that sum of money, and do I want to invest it all at one time, or do I want to invest it over a period of time? That's really the question that we are asking or are asked of us often. And even more so during periods of market volatility or geopolitical uncertainty that we've seen, because it's natural to feel a little uncertain about the future. So for example, I have a client who recently sold a home and had about $1 million to put into the market. We have a client. And he was wondering, do I invest it all as a lump sum and just put the money in, or should I invest some and then wait and see what happens and invest more down the road? And, the answer to that question, like much in our industry, is that it really depends on the client, on you and your preferences. There is a math answer to that question, and that's borne out by lots of studies. And the math answer would say that, 70% of the time, lump sum investing, so putting all of that money, investing all of that money at one time, 70% of the time, your returns are going to be higher a year later than if you had dollar cost averaged in over that period of time, over that year. And 1 year, 3 years, 5 years, the answer is the same. And the reason why is that markets trend higher over time. And so when you delay investing, when you hold some of that money back from investing, you're missing out on potential gains. So the math answer would say 70% of the time you're better off with a lump sum investment. But then there's the human behavior component. And before I go to the human behavior component, I want to point out that math answer is true even when the market's at all-time highs. Because that's a version of this question we get too, which is, oh, the market's at all-time highs. Should I be investing now? Is it likely that the market is just going to go down since it's at all-time highs? And what we know is, when markets are at all-time highs, they are likely going to be higher in the future. And Jason will, of course, have the statistics on that, the numbers. But I want to say on average, the market is, 14% higher the next year after a year where we have all-time highs, something like that. But anyways, so the human behavior component. So for this client, doing the lump sum investing, that felt really sort of risky to him. It made him feel uncomfortable about putting all of that money to work at one time. And although the math would say that's going to be what's likely going to give you the best return, it would be really hard for him to stay the course, to stay invested, and to sleep at night, because he would feel worried about his investment. And what we know is that it is time in the market, not timing the market, that's going to give us the best returns. So we came up with a plan, a calendar-based approach for putting that money to work with him. So every month, we're investing a set amount, and we've defined this ahead of time. We want to take that emotional component out of the equation. We want to avoid trying to time the market, like, oh, let's put some in now, and then I'll wait and see what happens. And when I feel good, I'll put more in, because we know that is going to have us constantly chasing the returns and reacting to the market. And so we want to take that sort of defined upfront calendar-based approach, But for him, that allows him to feel comfortable with the investment. And he's, for him, that's the priority. It isn't the potential of maximizing or ensuring that he is getting the highest return he could possibly get. It's sleeping at night. It's feeling good about, the putting that money with Albion into the market.
Well, thank you. That's a
I've
great
got
answer.
nothing to add. That was well said, Liz.
Well, I'm going to hop down to another question that feels related here. It's and Jason, you might have thoughts. With markets back to near record highs again, are stocks expensive right now?
Yeah, we get this question a lot, and valuation is more art than science. I would start with that. So one person's the market's cheap can be another person's the market's expensive. It just depends on your lens. But from our perspective, stocks aren't cheap, but they're more reasonable than they were just a few months ago. We had, of course, the gut check correction in March, given what's happening in the Middle East, and so prices came down while earnings expectations have continued to go up. To put a data point, a figure on the earnings growth, we are about 30% of the way through corporate earnings season right now. And earnings growth is running low teens year over year, 13, 14%. For the balance of 2026, expectations are that corporate earnings will grow mid-teens, 15, 16%. And so when you have prices in the market that are going down or from point to point, they're flat. And meanwhile, you have earnings that are going up, that resets the PE multiple or valuation, the gauge most people use. It resets it lower. And so when we look at the market at the index level, our view is that given what's happening with inflation, it's largely benign. Given what's happening with interest rates off their highs, but consistent with a balanced economy. Given what's happening with the economy and earnings, the economy's growing, earnings are really growing. So we have nominal GDP at 5%, we have earnings growth mid-teens. And so when you add those elements up, which we consider to be like the core fundamental cocktail that determines stock prices, and then we overlay that with a valuation number and we say, you know what, the market's trading at 22 times earnings, which is about where it's at. That to us doesn't feel expensive. Again, it certainly isn't cheap. The long run average is more like 17. And we don't have enough time on this call to unpack why it's low 20s the last several years and why it used to be mid to upper teens. But just know that it's not a far stretch from the long run average, despite the fundamentals looking better than they ever have. And so we think the market is reasonably valued, although there are certainly pockets underneath the market across technology and AI and the consumer and healthcare that are kind of varying degrees of looking really attractive or looking more expensive. So we're constantly sizing up market level valuations and then where the opportunity set is underneath the hood.
Okay, thank you. So this is another question submitted by a client here. What are your thoughts on the changes, and you'll have to maybe explain what these changes are, but what are the changes that are allowing the addition of private equity to retirement accounts?
I'd be comfortable taking a shot at that one. For those, many of you are aware of this, but private equity is a way to invest in non-public companies. Public companies are those companies that are listed on the New York Stock Exchange, the ones that we own, or other markets, so not just the New York Stock Exchange. A huge percentage of the economic system of the United States, the companies in that system are not public, they're private. So private equity is a doorway to invest in all of these companies that are not exchange or publicly traded companies. In 2004, there was about $750 billion in private equity funds investing in these companies. Now, Albion is a private company. We don't have outside investors. We don't want outside investors. But outside investors in 2004 had invested $740 billion, $750 billion in non-public companies. Right now, that number is getting close to $10 trillion in investments in non-public companies. these can be productive investments. And private equity covers a large gamut from smaller, non-earning companies that might have a rapid growth path to big established companies that somebody might try to take over, take private, to leverage them and perhaps maximize returns. So private equity exists. It's very much part of the financial ecosystem. What we have witnessed over the last 3, 4, 5 years is these big private equity funds are having a hard time selling their assets. Now, their investors, which tend to be big pension funds, insurance companies, large pools of capital, are concerned. They want their money out. But private equity is not able to sell those companies to anybody else at a price that they deem appropriate. Now, one of the advantages to private equity is you don't see the price changes because they just provide a value and say, this is what the company's worth. Well, the real value is what the market is willing to pay for it. And in these private equity funds, what the market is willing to pay for the private companies is less than what the sponsors of these funds feel is appropriate. So the sponsors of these funds are finding themselves in the difficult position of having their big investors breathing down their throat saying, boy, we need an exit. You got to figure out a way to get cash back to us because we need it to meet our obligations. Well, while the market is unwilling to pay the price that these private equity funds would like to receive. Now, I have on my cynical hat right now. If you are these big funds, you're saying, well, where are there pools of capital that we haven't tapped yet that might be willing to buy some of these companies? There is about $15 trillion right now in retirement accounts. That's a big pool of capital. So the notion is, if we create the possibility to buy private equity funds within these retirement accounts, well, now the purveyors of these funds have $15 trillion in assets to potentially tap to invest in more private equity. Now, it's not all cynical. There are advantages to private equity in some situations. But the timing of this effort to create a private equity asset allocation within retirement plans is a little suspect from my perspective, in that it would create a doorway for these funds to sell underlying companies into a new private equity fund, which is largely uneducated investors, if you will, or people who are not in that space. The institutional investors aren't buying these companies because they do the analysis. But if it's just a fund, they may be less willing to take those steps. So I'm challenged by the notion of putting private equity into 401ks. I'm wondering who it benefits. Another issue that will perhaps surface as private equity enters the 401k IRA space is required minimum distributions. As we tend to know, if you have money in these tools, eventually you're required to take money out. If a substantial portion of your 401k asset is illiquid, meaning it's in these private funds where you cannot control when you get your money out, that's controlled by the fund sponsor, you may find yourself in a challenging situation meeting required distribution requirements. So it's going to be interesting to follow. I'm a little bit concerned about it becomes a mechanism for the funds to offload product that they can't offload anywhere else onto, if you will, less involved investors. So I'd approach it with caution.
That was a great summary. I would just add, like, the one sentence way to think about it is that private equity's allure for so long was higher returns with less volatility. And that's the sales pitch for retail investors. It's the sales pitch for putting it into retirement plans. And yet, as John mentioned, the reason the volatility is lower is because they mark these things so much slower than public markets do. And for the pleasure of that supposed pitch, usually pay higher fees and higher costs and what's known as the benefit truly is around what's known as the illiquidity premium. And the more money that chases private equity, if we're doing this in retirement accounts, the more that premium shrinks or maybe even goes negative. And so, like most things, if it sounds too good to be true, it often is. So just think about it through that lens.
Okay, thank you. That was very educational. I just a couple more questions here as we round out the hour together, and I'd like to ask here, why are interest rates still relatively high, and what does that mean for bonds, mortgage rates, and cash?
Yeah, I'll jump on that one. Rates are where they are because base rates from the Fed are higher post-COVID. We talked about what the Fed's been doing. Rates went from 0 during COVID to 5.5% and have now settled into 3.6-ish% in terms of the base rate, the federal funds rate. So that's number one, a higher base. Two, the economy has held up better than expected. And three, inflation hasn't fully come back to target. And so when you look at like longer term interest rates, let's just call the 10-year treasury, really the rate, if the market's in equilibrium, the yield should be a function of those three things: base rates in the economy, the front end of the curve, where investors think inflation and the economy are going, especially inflation. And so those three elements, I think, have held up fairly well. The Fed hasn't cut back to 0, thankfully. And again, the economy is doing okay and inflation is above target. So when you add up the pluses and minuses there, you get to, 4.5% on the 10-year, which is where we've been for some time. I think the good news is that today's yields, from a portfolio context, today's yields are actually attractive for fixed income investors. I remember investing through the 2010s when yields were lower than inflation. You didn't have a real yield in a bond portfolio. And so, over the past decade plus, it was really hard to both diversify the equity side with bonds, but also provide some level of income. I like to joke that Jerome Powell put the income back in fixed income. And then so when we look at bonds, that's a good thing. And then cash yields are decent, but as we've said on past calls, over time, those are going to follow the Fed funds rate lower. And so if we see the Fed continue to ease at some point, which is sort of our base case, probably not going to cut this year, but sometime in 27 and 28, like John mentioned, like forecasting tells you more about the forecaster than the future. So like take that with a grain of salt. But generally speaking, the idea is that rates go lower, then money market yields will follow Fed funds rate lower. And so I guess the last thing is mortgages. That's certainly one area where everyone pays pretty close attention to, just given how much it punches above its weight in terms of the economy and how that can impact housing affordability. Rates have been high because 30-year mortgage rates have been high because they're priced off of the 10-year with a spread. And that spread has been wide, really kind of post-COVID. And so when you take the 10-year treasury yield and you add that spread, we've had mortgage rates that have been largely in the 6% area. We don't have enough time to unpack why that is, but that's generally where we are. So if the 10-year yield comes down a little bit, we would expect mortgage rates to come down a little bit, all things equal.
And we've already seen rates on money markets come down, right? As there have been cuts, or at least come down from their highs, right? So that momentum has started. Certainly, we've stalled out for now, but people are already feeling that.
Yeah, the 30-year mortgage got close to 8% at the high, and we've been bouncing around the low sixes. So yeah, you're right. It has tracked lower.
Okay, thank you. So then this is my second to last question here. Given everything happening, should we be making changes to our portfolios or staying the course?
You guys know I love this one, so I'm going to jump on this and then please add as needed. But central to our investment philosophy and core approach, we say stay disciplined, diversify, and own quality. Don't let headlines dictate asset allocation or your desire to own assets whose primary goal is to underwrite a long-term financial plan. Volatility is a feature, it's not a flaw of long-term investing. I'm really throwing out the Jason word salad aphorism list here because I just think it's so important. At the end of the day, our job is to keep portfolios aligned with your long-term goals, not to react to every geopolitical headline, Fed headline, economic data point, or market dip. We think the fundamental backdrop remains supportive, as we've described, especially for long-term money. And I like to say, if you're a long-term investor, don't let 10-year money turn into 10-minute money or 10-week money or 10-month money. Keep long-term dollars invested. It's time in the market, not timing the market. But we also have to recognize, appreciate, and accept that the ride's going to be bumpy. It's not smooth. When we look back at history and we see, oh, the S&P has gone from 1,000 to 7,100, and you see that chart, it's easy to say, oh, well, that was easy. That was easy money. But it's never easy money in the moment. It always feels scary, like Liz said, when markets are at all-time highs. And by the way, to throw a number on that, they're at or near all-time highs around 50% of the time. And so when we're at highs, people are worried about things dropping. And when we're going down, they're worried about them going lower. So just ignore that, stick to the plan, think and act long-term. And that's usually what gets us through, rough periods.
Jason, I don't have a lot to add to that. That's it.
Okay, thank you. That's it's good to hear your messaging on that question, because it is a question that everybody thinks about. So finally, this is a final question, but it's an important one on cyber threats and security. How does Albion ensure that my data and information is safe and protected?
That's a great question. And it's something that we, both because of who we are and because of our regulators, we put a lot of effort into. And there are really three levels, if you will, of protection that we work on. First is the custodians. As you know, we don't hold your assets. And the custodians have broad and deep cybersecurity groups working to protect those assets every day, all the time, from threats. The second layer is our vendors. We use a variety of tools, and every one of those vendors has to be vetted for their work in making sure information stays safe and protected. The final level is Albion, and the work that we do here, both electronically in terms of our firewalls, our tools, our ways to screen information, and physically. How are we training ourselves? Most compromises are the result of human error. And we have a comprehensive and ongoing training and awareness program in-house that we follow to make sure that we are aware of what is happening and what the techniques are that bad guys are using to try to make us compromise information. So when we put those three pieces together, which we continue to monitor and enhance, our goal, of course, is to never have a breach. And I'm hesitate to make promises, and I just knocked on the wood of my desk, hoping we can continue to do that, which we will continue to work hard to do. The goal, of course, is you don't have to be, we want to be 100% hack proof. More important is we want to make sure we're a really hard target, so a bad guy goes somewhere else. And so our goal is to make sure we are always a really hard target.
Maybe we can think about that, John, as keeping the porch light on. If you talk to law enforcement folks, like the number one deterrent from someone breaking into your home is just having your porch light on, or like your light over your garage on, and they'll just choose another house. So all of those layers you mentioned, which are very robust, and we work very hard on, is like this big floodlight on Albion.
Right.
Okay. Excellent. Thank you so much. This has been a rewarding session, and thank you for answering these questions. We can now go through and let everyone have a few closing remarks if you'd like, and then and we'll end the call just 2 minutes after the hour approaching.
I just want to say thank you, David, for doing such a wonderful job moderating. We really appreciate it. And thanks to everybody who's joined us today. Hopefully you're taking away some nuggets of information from the call.
I second that.
And I would like to say thank you to the panelists. As Albion has migrated through decades and decades of service to our clients, I am just in awe of the people I get to work with. the thought, the caring, the intelligence that they bring to these calls, as you've seen with David and Liz and Jason, and to every bit of work that they do for the clients. I feel very fortunate about the wonderful team that I get to work with every day. So thank you all, panelists.